This is Let's Talk Energy, your go-to podcast for smart energy insights. I'm your host, Noah Brenner, and each week we're bringing you an inside look at the dynamics shaping global energy markets through in-depth conversations with our own Rystad energy experts and some special guests. For our first episode of 2026, we're diving into the global oil market to try to understand how supply, demand, and geopolitics could influence prices for the most important traded commodity in the world. Forecasters almost universally agree that crude markets are likely facing significant oversupply in the months ahead, as growth in oil supply outpaces growth in oil demand. While prices for benchmark Brent and West Texas Intermediate, or WTI, have certainly drifted down in recent months, both prices and balances have proved more resilient into the end of 2025 than many had expected, and they're continuing to hold up in the early days of 2026. So, just how much extra oil might be sloshing around in the global market, and will it necessarily trickle down to the prices consumers pay for fuel? Will geopolitical turbulence, including the recent arrest of Venezuela's President Nicolas Maduro, outweigh the fundamentals to support higher than expected oil prices? Or, if prices do fall further, how might key producers, such as OPEC Plus and U.S. shale players, react? To help us understand the most important drivers influencing 2026 crude and products markets, I'm joined today from London by Janiv Shah, a vice president and oil markets expert in our analysis division. Janiv, welcome to the program.
G'day, Noah. Thank you for having me on today.
And I'm joined from Houston by Corey Stewart, director of pricing for Americas for General Index. Corey, welcome.
Thanks, Noah. Happy to be here today.
Well, gentlemen, let's talk energy. Corey, before we get started, I think most podcast listeners are familiar with Rystad Energy by this point, but they may not know General Index. So can you quickly just give us a snapshot of what General Index does?
General Index, or as we call it, and as are on our ICE listings, GX, is a global commodity pricing agency focused on delivering independent, transparent price assessments across crude oil, natural gas, environmental products, just commodities in general. What differentiates us is that we are deeply rooted in the physical market. Our prices are built off real transactional data, robust methodologies, and constant engagement with market participants. I do want to make this disclaimer. It's important to note that GX is not currently involved in forecasting. So much of what I say today is my opinion and not necessarily held by others at GX. Also, I'm fortunate to lead a highly capable team in Houston with deep specialized knowledge across their respective markets and to be part of a broader global market experts, GX.
What I want to start with is prices. I think that's what people care about the most, and then we're going to work back from there and figure out how we arrived at some of those figures. So where do you each, I guess, see average oil prices in 2026? And then maybe what might be the exit price on, say, 31 December? And then we can kind of understand the trajectory we might be seeing in the market. Janiv, let's start with you on this one.
To be honest with you, even trying to forecast the price until the 31st of January is probably as difficult as any other year. There's a huge amount of geopolitics, of course, in the last 4 or 5 days that have taken the world by storm, specifically looking at what's happening with the US and Venezuela. But let's not also forget that there's still a big Russia-Ukraine bubble, which is still waiting to either expand or burst in a separate way. Where do we see prices for 2026? Our average is around $60. And that is an $8 drop from 2025's average. But that forecast was done pre the end of the year, so pre-US Venezuela eruptions, which also means there's a bit of downside risk to our prices. We may be looking at, instead of an $8 drop, closer to 10, maybe even going deeper into the double figures, $11 or $12 year on year. Where we sat in our current estimate at the end of this year, we're at a $58-ish range. The cyclic seasonal pattern as summer demand heats up, prices also start to increase. But then it's obviously would drops through the end of the year with Q4. We might see some downside risk to every month shifting down by $1 or $2. This geopolitical risk premium is overtaking absolutely everything. And today's announcements by anyone in the market could be reversed tomorrow by another announcement from a separate part of the world.
Corey, where do things sit for you? How do things look?
I think 2026 looks like a market that broadly remains range bound rather than directional. I put the average Brent price somewhere in the low to mid 60s. Mid is probably stretching it. I'm here the low. Largely because we have enough supply growth to prevent sustained rallies, but also enough supply management and geopolitical risk, but also to prevent a collapse. So by year end, I think prices could be somewhat softer, probably low 60s to maybe even high 50s, 57, 58. I think that's very reasonable, especially if inventories build and time spreads weaken. What I'd emphasize is that the market may feel weak structurally without necessarily being cheap outright. A lot of the signal will come from the shape of the curve rather than the flat price.
Obviously, the big news of the past week has been Venezuela, the removal of Maduro, questions about what comes next for the country's oil industry. Prior to the ouster of Maduro, we saw the U.S. set up a naval blockade and commandeer dark fleet tankers to really shut down Venezuela's crude exports. Honestly, in both cases, markets didn't move too much. And when they did, it didn't really hold. So, Corey, let's start with you. Why didn't we see Venezuela cause a more dramatic and sustained impact?
In pricing terms, those barrels have already been written off as far as like reliable supply. So for years now, Venezuelan crude is traded with heavy discounts, irregular flows, and constant political risk. Markets don't respond strongly to disruptions in supply that they weren't fully counting on in the first place. Another factor is the refiners have already adapted, right? So buyers who once relied on Venezuelan grades have diversified their slates, invested in flexibility, or found alternative heavy barrels. So when enforcement actions or blockades happen, so as you mentioned, they feel more like confirmation of risk rather than a new shock, and prices tend to shrug that off. It's going to take a significant amount of time to repair Venezuelan oil infrastructure. Hopefully, Janiv will agree with me there, to get anywhere near where the country was historically as far as production and exports. I mean, how long have we seen the U.S. military activity ongoing in the Caribbean in relation to Venezuela? Perhaps the capturing Maduro was not on our bingo cards this year, but U.S. policy towards Venezuela and the inherent price risk has been, to me at least, priced in for a while.
Well, Janiv, you brought up the potential for the developments in Venezuela to actually lower Rystad Energy's base case prices by $1 or $2 maybe. So there could be some impact, even if it's not immediate. What are, I guess, some of the scenarios, maybe near term? And then I say medium term, but really let's put a bookend on it at the end of this year that you're watching in terms of how Venezuela could impact the oil market.
What the market's looking at is how quickly can Venezuelan production ramp up. And that is not a 2026 story. That is much, much beyond, right? So what we're seeing from the numbers is around $50-ish billion worth of upstream and infrastructure investment is needed over the next 15 years. I know you mentioned what's happening at the end of this year, but over the next 15 years to just maintain flat production at 1.1 million barrels a day. With that, the upside in the immediate short term, and this is the immediate short term of 2 to 3 years, is only around 200 to 300,000 barrels a day. So all in all, it's a drop in the ocean for a global liquids market, which is 100 plus million barrels a day of supply. And if you're talking about crude and condensate alone, it's 80 or 85 million barrels a day. So 200 or 300,000 barrels a day additional is rather minimal. Going forward to what was typical historic Venezuelan production volumes, 3 million barrels a day. We only see that coming to fruition around 2040. And the issue with that, or it's not really an issue, is it requires a huge amount, $35 billion of international investment or international capital. There are short-term risks, and a lot of the short-term risks reside with what's happening within China and the Chinese refineries sourcing material and how the reshuffle of heavy crude will occur. But on the shorter term, it's also what is the stability from a political sense within the Venezuelan governmental regime, and how does the U.S. Let's not use the word dictate, but how does the U.S. move forward from the 21st century's edition of the Monroe Directive? So it's very much a U.S. policy-driven understanding of what could happen next, but it's heavily weighted towards the end goal. The end goal here, first and foremost, being lower energy prices in the U.S. For consumers and gasoline pump prices at the start.
Do we see this same kind of oversupply of products as we do of crude, and therefore lower prices, or is this actually a case of 2026 being a very good year for refiners? And either of you, feel free to jump in to start that one.
I'll start off, and Janiv, I'm sure you have some information there as well. But products markets don't look oversupplied in the same way crude does. And that distinction really matters. While crude supply growth is relatively abundant, refined products are constrained by capacity, outages, maintenance cycles, and product-specific specifications that limit how easily the system can respond. Demand for products like gasoline, like the marquee products, gasoline, middle distillates, is still so tied closely to mobility and economic activity. And in many regions, that demand remains resilient even when crude balances look long. As a result, 2026 could still be a relatively constructive year for refiners. Margins are likely to be more volatile and more regionally differentiated, but we continue to see structural tightness in certain products, particularly middle distillates, alongside limited new refining capacity. That means lower crude prices don't automatically translate into weaker refining economics, and in some cases, they can actually support margins by reducing feedstock costs while product prices remain firm.
Janiv?
The crude market is seeing a growth. If I put the numbers out there from our Rystad data, is seeing a growth around 2.4 million barrels a day. And if you look at a crude balance, a crude and condensate balance, the refinery run growth year on year into 2026 is only 770,000 barrels a day. So there's a huge amount of oversupply, which is putting a lot of pressure from a fundamentals perspective on the crude market. Let's switch over to the products market. Noah, as you mentioned, that's the key question here, is that we're only seeing product demand growth of end-use products of around 860,000 barrels a day. So not huge, not a million barrels a day of growth like it was pre-pandemic on a historic straight line chart. But nevertheless, let's make no mistake, for another year, another consecutive year, it is higher than the refinery run growth year on year. This is what we're seeing is a continued tightness in the products market. And yes, it's split regionally and again, split by each product. So we're looking at continued strength here in Europe, sat with the distillates, diesel gas oil markets. With the US, something similar on gasoline. And if we look at the typical or the average yield for 2026 for gasoline in the US, we're sat at 50.5%, which has some upside, of course, with the capture of or the incremental of 30 to 50 million barrels of Venezuelan heavy sour, which can be upgraded. But here within diesel, within the European diesel yields, we're seeing around 43%, which has a significant upside. But we are now in the Atlantic Basin, constrained by a lot of refinery-based economics and closures. Asia and the Middle East are the two key regions where we see a lot of upside potential in raw utilization, in raw capacity upside, and in raw refinery runs at the end of the equation. So this could be the answer to the rest of the global tightness. But from the refinery margin perspective, not a bumpy year from 2022 with the Russia year. It has been decreasing every year thereafter. And we do see some decrease from 2025 into 2026, but still remain supported. So tightness in the products market and some bearish news for the crude market.
So I want to talk about some wildcards here on both the supply and the demand side. And let's start with demand. In 2025, China played a big role in putting a floor under oil prices by building larger crude reserves, essentially stockpiling some of this quite affordable crude at a rate that was quite honestly unexpected by many. So do we see that stockpiling continuing into 2026? And could that potentially provide some upside to these demand figures that we've just cited?
The Chinese stockpile numbers for 2026 are almost downgraded from 2025, but still have some downside risk. So we're looking at a 220,000 barrel a day on average stockpiling basis for 2026. But a lot of this is known by the discounted barrels, so the Venezuelan, the Russian, and Iranian grades. Now, with the rerouting, with the potential full rerouting of the 500,000 barrels a day from Venezuela that flowed over to China in 2025 on average, that provides a little bit of downside risk. And where will China decide to purchase this discounted basis from? We are seeing early reports of Iran could be the answer, but there are very few alternative answers to the Venezuelan heavies. You know, you could have Canadian barrels, which aren't discounted, flow at market rate, as well as Iranian grades, so who, again, under a little bit of a discount, but again, sanctioned. So let's not make a mistake that it is a supporting factor, but it is slightly diminishing with the latest news of Venezuelan material flowing away from China.
Generally, I agree with the same thing, right? So China's strategic from commercial stockpiling. It's been a meaningful wild card, and I do think it continues to play a role in 2025. You've given some numbers around that, although probably in a much more opportunistic way, a less consistent way than it was in 2025. So, of course, when prices soften and time spreads move into contango, China has shown a willingness to step in and absorb barrels into storage. As you mentioned, that's limited there, which effectively puts a floor into the market. So even if end-use demand is not particularly strong, from a demand statistics perspective, I guess that matters because those barrels still show up as crude demand, even though they are not immediately consumed. So global demand can look healthier than underlying end-use might suggest. I think the key point here is that this type of demand is price sensitive and discretionary. It supports the downside when prices are weak, and it's unlikely to drive sustained upside or strong price rallies on its own.
I want to switch over to the supply side. The two most flexible and therefore probably price-sensitive sources of oil are the OPEC Plus producers group and their production policy, as well as U.S. shale producers who have that flexible short-cycle supply. The question I keep getting asked is who will reduce production first or more out of those two groups? And I want to start with perhaps how OPEC could react to this market and the trade-offs between defending market share and defending price. Janiv, why don't we start with you there?
The market share is, let's say, twofold. There is the global market share from a long-term perspective, which is based on raw production volumes from OPEC Plus and I guess non-OPEC Plus, which moves very minimally. The other market share perspective that is a bit more dynamic is how many volumes or how many barrels flow over from the Middle East, let's just say the Middle East or OPEC Plus nations, into specific markets. Let's just talk about how Saudi allocations from their barrels go into China. And that is a market share that they would be protecting. And so you've seen with the Saudi OSPs dropping and allocations to China rising as a result. So there is a little bit of cause for concern without putting too much stress on that, because the way the market's been managed by OPEC Plus is within the market structure, right? Protecting the backwardation such that when there is any supply requirement, that is, the traders who could have stored barrels during a contango phase are not able to, but it's instead OPEC spare capacity which could be drawn upon to provide those barrels for the market. That is a worrying sentiment because 2 days ago the Dubai M1 M3 flipped into contango. So there are signs and signals now that this impending global oversupply that has shadowed over the market for the last 5 or so months is actually coming to fruition, and we are flipping from a market structure of backwardation into contango. What's on the cards next for OPEC Plus? Yes, there is the pause of the unwind for the 3 months. That could be extended beyond the 3 months, beyond the first quarter of this year. But, let's not write off that they could start to accelerate if there's more of a market share understanding, or they could also continue to pause or even maybe cut at some point in the future. So very dynamic, and it's based on a month-on-month, based on the market structure is the OPEC Plus way.
Corey, you're in Houston, the epicenter of the U.S. shale industry. What do you think about how U.S. shale producers could respond? I mean, they're going to need to balance capital spending needed to keep those barrels coming out of the ground, as well as the trade-off with continuing to pay their shareholders dividends and buybacks that have become to be expected. So what does U.S. shale do?
The capital discipline is real. Shareholder returns matter, and most producers are operating within relatively fixed capital frameworks. Short-term volatility does not immediately translate into drilling decisions. We've seen some of this over the last couple of years. Another key factor is hedging. So many producers lock in cash flows months or even years ahead, which smooths their response to these price changes. So unless prices stay low for a prolonged period, we are unlikely to see really a sharp supply pullback. Shale is responsive, but it is not impulsive anymore. And I think that has big implications for how prices equilibrate.
Janiv, do you have a view on at what price that shale might need to be responsive?
The number sort of differentiates by basin, by quality, also by operator. Of course, you've got the bigger operators who have a better break even. But the number out there starts with a 5, and we're starting to hit that range. Especially in TI. TI this morning or TI today was around $55, $56. So it's still profitable, but much is to be seen how much that can be depressed by the avalanche of material coming into the US system as a whole.
I want to come back to this idea of geopolitical risk that both of you touched on at the top of the program. Russia-Ukraine war, including airstrikes on oil infrastructure, sanctions on Russian producers, and obviously the shadow fleet. And we still do see continued tensions in the Middle East. So which developments, I guess, in either region do you think have the potential to move crude and products markets? I mean, Corey, as you said, kind of which barrels are being counted on and what could happen in those two kind of spheres that you think people need to be aware of and what's already priced in, I guess. Corey?
Even though the market has been somewhat muted in its response to geopolitical events, especially with Venezuela, developments in both regions that you mentioned, they remain critical, particularly for the flow and pricing of certain crude grades and refined products. Russia and Ukraine, airstrikes, sanctions, export restrictions can immediately affect the availability of medium and heavy crudes that Europe and Asia rely on. So creating an additional tightness in specific differentials, even if global crude balances are technically long. Product markets can be even more sensitive, especially diesel and jet fuel, so middle distillates in Europe, where supply is already tight and alternative sources are limited. Now, in the Middle East, the biggest risks come from disruptions to key shipping choke points, production outages, which is kind of always something, or escalations that could temporarily remove those barrels from the market. So even the short-term disruptions can ripple through prompt and regional markets, affecting both crude and products. I think for traders and refiners, the key is understanding which specific grades and products are exposed, because overall headline supply may appear adequate, while the localized shortages create volatility in prices and spreads.
Janiv, I mean, we have been talking generally, or oftentimes quite generally, about oil and not these specific grades. I mean, where do you see the potential for either tightness or potential loosening markets when we're looking at specific types of crude that, based on the viscosity and the chemical composition across the world?
Talking about Russia-Ukraine, just really quick, is that yes, that's probably one of the solvable actions or solvable points in the world over the next, let's say, half year. And part of the reason why is you're looking at midterms on the US side for this year, which the ultimate goal of reducing energy costs and freeing up Russian, not just crude, but Russian products into the global system could support, could depress prices and support a bit more loosening of everything. Noah, your question here around the tightness in some specific crudes, which we've mentioned here, the Venezuela in quite a bit of depth, but yes, Venezuelan heavy sours and the replacement barrels for these for Chinese refiners are typically Canadian heavies or even Iraqi Basra heavy barrels, which are not in a huge amount of oversupply, right? So the light sweet basis or light sweet complex on the crude market is very much well oversupplied. You'll see how Brent, TI, Brazilian, Guyana grades, all of these, Argentinian, they're all coming onto the market in increasing volumes. So it's very much the sours and the heavy volumes and heavy barrels which are undersupplied. Moving forward, this is likely to be the continued case. Even though there is a global oversupply of crude, there are still some complexes which are under a little bit of pressure. If you look at where the sanctioned balance comes from and where the non-sanctioned balance sits, the sanctioned balance, including Venezuela, Russia, and Iran, typically only export. So there's lack of importing basis into those countries. So those are the ones in terms of the bottleneck, which could support a little bit of loosening in the global fray, in the global market.
I want to switch over and talk a little bit more about demand. I guess, are there other countries? We've talked quite a bit about China, primarily when it comes to demand. Are there other countries, whether that's India, obviously rapidly growing, massive economy, the US, that we should be watching as bellwethers to understand what the demand trajectory is going to be? Or is this really is demand a China story? Does it continue to be a China story in 2026? And either of you feel free to jump in there.
There are a few other countries and regions I'd say that are worth watching pretty closely. So Southeast Asia as a whole is becoming increasingly important, particularly countries like Indonesia, Vietnam, Thailand, where oil demand growth is closely tied to economic development, rising vehicle ownership, and expanding aviation markets. These countries do not individually move the market, but collectively they can meaningfully influence global demand growth at the margin. The Middle East, I think, is another underappreciated demand signal. Domestic consumption in countries like Saudi Arabia and the UAE can swing significantly based on power gen needs, pricing policy, and economic activity. And finally, Europe matters less as a growth engine, but remains a useful barometer. So I think sharp changes in European demand often reflect broader economic stress or recovery, and which can ripple through global oil markets, even if the region itself is structurally in decline.
If I would say one thing, it would be across the product split. So diesel, gasoline, and a few other complexes have reached their pre-pandemic values or demand bases. So the only one that is one of very few, including naphtha, is jet, right? So jet for some regions and countries hasn't really fulfilled or reached its pre-pandemic levels, let alone hitting the growth potential. So that is one of the key growth areas that we see, specifically even for China, right, going into 2026 and 27. This is the complex which is increasing as a year on year. Other than that, agree fully with you, Corey. India and even Southeast Asia are likely the hotspots moving forward in terms of growth and economic development. But the direct crude burn perspective within the Middle East, as temperatures get hotter for power generation, let's all keep a very close eye on that. Last year was a bit of strength, 1 million barrels plus. This year we could see a little bit more, but there's the weather prediction. We have to wait for that one.
Gentlemen, it's been a fascinating conversation. We are bumping up on time here, but I wanted to just give one opportunity. Any wildcards that you would flag up, things that, maybe just to keep an eye on. I'm thinking last year, we had the surprise of China's LNG trucking industry kind of taking off and all of a sudden undercutting some of the demand assumptions. Maybe one thing, couple of things that you would say, okay, keep an eye on this. We don't know which way it'll go, but this is a wild card worth knowing about.
I think that risk is very real, and the experience with LNG fuel trucking in China is a good example of how quickly demand assumptions can change. When the economics line up, substitution away from oil can happen faster than most forecasts anticipate. You can all kind of realize that, especially in segments like trucking where fuel costs are a major operating expense. I'd say that electrification is still at an earlier stage, but improvements in battery technology, charging infrastructure, and policy support, it could start to have a measurable impact at some point sooner than many models assume. That said, I think this likely shows up more as a drag on demand growth rather than outright collapse in demand. I think it's less about oil demand falling sharply and more about incremental growth being shaved off year after year. So for the market, that kind of surprise matters because it reinforces the idea that demand is less reliable as a balancing mechanism, putting more of the burden on supply discipline to support prices. And also this, again, it's about how the economics line up. Hub-based shipping works well for example, electric delivery vehicles, maybe LNG trucks. And in the case of somewhere like China versus the US, it's just maybe a longer kind of term thing. Even for personal vehicles, there wasn't the rotation out of an established car park. So it was purchasing of new vehicles. And I jumped on this. It's a shameless plug, but be watching GX next year, or this year, sorry. We're in 2026. This year for LNG indexes this year.
Bingo list for this year. I'd say keep an eye on refineries. That's very broad, but yes, with the current strength in the products market, we're forecasting to continue through this whole year, the entirety of the year, and the weakness in the crude market just means margins are going to be fantastic. So we do see continuation of, and maybe some refineries even decide to forego some maintenance. Just putting it out there, it could be a thing. But running harder, high utilization rates also means higher unplanned outage basis and a bit of volatility on cracks. I think the other one, if I bring the second point in, is likely to be the tanker market. In recent days, we've seen the US chase a Russian or not Russian vessel across the water. And let's be aware that this is probably some form of pressure and allowing for sanctions to either continue, be elevated to another level, or for them to come off in the form of a peace deal. So this, the evolution is starting to spread across multiple assets and multiple markets. And let's be aware that this could spread into anything else. Stability is fantastic. You've seen how gold has popped off and continues to be strong. So I guess 2026 proves to be a little bit volatile, much like the previous couple of years.
Well, gentlemen, thank you for a fascinating conversation. Really appreciate your time and joining us on the program.
Thanks for having me.
Appreciate the conversation.
let's recap. There's shaping up to be a material surplus in oil markets, but shifts in supply, particularly from the OPEC Plus group, could help alleviate some of the impact on prices. Geopolitical events are certainly impacting prices, but are more likely to keep prices from going lower rather than pushing prices up, as we may have seen in the past. And finally, low oil prices may not fully trickle down to prices at the pump or at the airport, as tight refining capacity means oil product markets are not nearly as oversupplied as those for crude. Thanks for listening to Let's Talk Energy. This podcast is a production of Rystad Energy, produced by Laura Rodriguez-Skaug and Bora Og. Check out the show notes for further analysis on the topics that we've discussed in this episode, and connect with us on social media. We're at Rystad Energy on all your major platforms. While you're there, please leave us a review, click that subscribe button, and hit the like button as well. You could keep up to date with us as well on our website. If you'd like to send us questions or reflect on today's show, email us directly. It's podcast@rystadenergy.com. And most importantly, don't forget to join us next week for more Let's Talk Energy.